Okay, great. Well, thanks to the organizers for having me on the program. Really excited to be here and talk about my paper on the allocation of socially responsible capital. Okay, so it shouldn't really take much motivation to let you all know and get on board with the idea that investors are increasingly thinking about non-financial, or just don't want to say non-financial, but things other than the normal financial metrics about a firm when they're investing in their portfolio. A lot of investors are starting to incorporate their social preferences into their investment decisions. And there's a broad category of typical approaches investors take to doing this. They basically think about the financial returns of their portfolio and some measure of the social value of the companies they are investing in. Right? And in this talk, I'm going to be very loose and broad about social value. You can think about it as kind of like the negative of emissions, or you can think about it as a composite of a lot of different things: how you treat your employees, externalities you impose on society, things investors might care about, things that you can think about maybe, if you want, is thinking about some aggregate welfare function that includes externalities. Okay, again, the key I want to emphasize here is investors think about the financial return and some measure of the social value of the companies in their portfolio. And there's a couple examples of this. So you can think about funds that do ESG or carbon weighting. You can think about exclusion portfolios that say we're specifically not going to invest in bad companies. You can think about net zero. A lot of endowments and big pension funds are now saying they're going to be net zero by a certain date, which means they're going to make sure that if they have companies emitting in their portfolio, weighted by the dollars they have invested in that company, they have other companies that are a sink of carbon, say. Okay, and why do they do this? Well, there could be many reasons, but the one I want to talk about today is the idea that investors think they're actually going to kind of make a difference in the world by adopting social preferences in their investment choices. And there's this folk economic wisdom, which is basically we can vote with our wallet, right? And we can tilt our portfolios towards socially valuable firms that'll increase their market value or equivalently lower their cost of capital, and therefore shift resource allocation in the economy towards kind of better firms and away from bad ones. And that makes sense, but it turns out there's some nuances. So what I want to do today is kind of think about a structured economic model and logic to understand how investors, if they want to make a difference in the world, should invest. Should they structure their portfolios like the ones we're used to seeing, or is there a better way, and does this really folk wisdom hold up? And to do that, I'm going to start with something that's not my own contribution, but this idea of additionality that comes from Bress, Gilson, and Wolfson. And basically what they're saying is they make an argument, which I'll explain in a few slides, that your contribution to social value as an investor is not the social value of what's in your portfolio. Right? It's not just like if I invest in a solar panel, I get to take credit for the positive externalities or whatever from that solar panel. And the key reason, I'll say it once and I'll say it many more times, is that maybe someone else would have done that in your absence anyway, right? And so what value are you adding to society by doing it yourself? So what we're going to do is and that's the idea of additionality, we're just going to put an economic model around it and understand the equilibrium consequences of additionality in investor behavior. So we have kind of four main results. The main result I want you to take away, if you remember nothing else, is that relative to this traditional approach of doing like an ESG tilt in your portfolio, there's alternative strategies you can take as an investor in this world in equilibrium that will give you both higher financial returns and generate more good in the world. So as an investor, relative to this kind of ESG style of investing or carbon weighting, you can both do better and earn more money. Kind of an implication of the framework we're going to put forward is that green bonds, for example, arise as a way to help investors generate impact. I'll talk a little bit more detail about that. And then I'm also going to talk about this from an organizational perspective rather than an investor perspective. So instead of thinking about how investors can make the world better, we can ask how can firms make the world better if they care about that. And they could make the world better by literally making the world better directly, or maybe not. So what I'm going to show you is a result that in some cases firms can improve their impact on society by focusing on profitability rather than direct social value creation. And I'm not going to have time to talk about this actually, but the model delivers this interesting negative assortative matching between investors and the products they invest in. In particular, if the investors that care most about social value actually should invest in the companies that are relatively less socially valuable and save the most socially valuable investments for investors who care least about social value. Okay, so I decided I'm not going to present the actual model. I'm going to give you kind of two examples that have all the economics needed to make the point of the model. I think that's an easier way to communicate the results. If you're interested in the model, please read the paper, and I'm happy to talk about it. I'll show you graphically the equilibrium, like a graphical representation of the equilibrium, and I'll go through those additional results I highlighted. And then if there's time, I'll show you some very loose empirical support for some of the things I'm saying. Okay, let's start with a simple example about what is this idea of additionality. Again, this is not my contribution. This is coming from the literature. So let's think about an economy where there's one social investor. They have one unit of capital. And this investor cares equally about financial return and social value. And I'm not going to say yet how they care about social value. Just think they're willing to trade off some idea of social value for financial return. There's a commercial capital market that's going to elastically supply capital at a 5% cost. So any project that can generate more than a 5% return on investment could be financed by commercial capital. And there's two firms in this subset of the economy. You can think there's this kind of outside commercial segment of the economy. But here there's two firms. Firm A generates 6% profit and 10 units of social value, and firm B generates 4% profit and 9 units of social value. And the question is, which firm does the social investor finance? And the answer is it depends on how the firm thinks about social value, or how the investor thinks about social value. So I've just put these firms back up here. So if you're what I'm going to call a values-aligned social investor, the way you think about social value is the way that motivates these ESG or carbon-weighted portfolios. You take credit for the social value of the thing you invested in directly. So if you're a values-aligned investor, you're going to look at your options here, and you're going to say, well, I'd really like to invest in firm A because it generates 10 units of social value. And to do that, I have to compete with the commercial capital market because this firm is quite profitable, right? So I'm going to offer them financing at a cost slightly lower, epsilon lower than 5%, and the firm is going to say, okay, well, the commercial capital market would have offered me at 5%, I'll take yours. So now the social investor gets to finance firm A, but firm B is not commercially viable and it goes unfinanced. So the total social value in this economy, the total welfare, say, is 10, right? So 10 plus 0 because firm B doesn't get financed. Okay, now let's think about what I'm going to call an impact-aligned social investor. An impact-aligned social investor thinks about their contribution to society in the sense of, well, what would have happened in my absence? We have like a game theoretic foundation of that in the paper. For now, just think about them as saying, well, they understand that if they finance firm B, firm A will be commercially financed. So this kind of investor is going to support firm B. Firm A is going to attract commercial financing. Since the social investor is not facing any competition from firm B, they can extract all of the profits of firm B with the capital they offer. So they're going to get a 4% return, and 19 units of social value will be created. And the key here is, this is the basic additionality argument, that you have to think about who you're displacing as an investor to think about social value creation. If this would have happened anyway, you're not really creating social value. And this seems like an obvious point, but I want to try to now connect it back to like thinking about how you should design your portfolio if your aim is to generate impact. Also note here, the social investor is getting 4% if they have these impact-aligned strategies versus 5% if they didn't. So here they are not making more money, but they are generating more impact. So now I'm going to show you that actually can flip. And the way that flips is through the role of competition between socially minded investors. So I'm going to modify the example a little bit by introducing a second social investor, and that they're going to compete with the first one for investment opportunities. Same commercial capital market. Now there's 3 firms. Okay, firm A and B are the same, and I've introduced firm A prime, which makes the same profit as firm A, but generates higher social value by 2 units. So now, again, which firms do the social investors finance? I want to focus on the values-aligned investors. So I've copied up these firms again. So the values-aligned investors in the equilibrium are going to go for firm A and A prime because they're attracted to the high social value they generate. B does not get financing because it's not commercially viable and there's no other source of capital available. So the investor who finances A is competing with the commercial capital market because A is commercially viable, and they're going to offer epsilon less than 5% cost of capital for this investment. Okay. Now, these two investors, social investors, are also competing with each other, and their utility is a function of what their financial return is and what the social value of the company they're investing in is. And I said before, they're equally weighted. So think you're willing to sacrifice 1 unit of return for being able to claim association with 1 unit of social value. And that means that for these investors to be in equilibrium, competing with each other, the investor that finances firm A, who's going to get to claim 2 more units of social value, is going to be able to have to take a 3% less return. So they're not undercut by the investor that's investing in the first firm. Okay, so now investor who's investing in A prime gets a 3% financial return, and then only 2 firms are funded, the first 2, so there's 22 units of social value. So now I'm going to show you a deviation, right, that is kind of the result, the first result, that you can make more money and have more impact. The firm A, the investor that's investing in firm A prime can deviate and finance firm B. Nobody's offering firm B any money right now, so they can extract all of the profits from the firm by providing capital. So if they do that, they'll get 4%. Because firm B is financed now, that leaves a hole for firm A prime, and firm A prime is going to be able to take commercial capital. So the idea here is now the social welfare is higher, it's 31. So this investor, by deviating from their other strategy, is able to really comfortably say they're creating social value relative to the old equilibrium. They are actually increasing social value. They're also making more financial return than they were. They're making 4 instead of 3. Okay, so what's going on here? I've said it before, but I'll say it again. There's 2 sources of competition that are creating an issue here. One is that these values-aligned social investors are competing with commercial capital. So the key idea is, to the extent there's a correlation between, or some weak correlation between profitability and social value of firms, if there's any firms that are commercially viable but also generate social value, you want to leave those firms for commercial investors who don't care. Or more generally, and that's where this negative assortative matching result comes from, leave them for people who care less than you. The second problem is competition among these investors, the social investors. It's bad enough that you're displacing a commercial investor from something they would have financed, but now you're taking a social investor who is willing to make a concession, right? Their preferences here are they're willing to have some sort of lower return to be a part of social value, but they're in a sense wasting that concession by competing with each other and transferring their concession as a rent to the owner of this firm. So we talk more in the paper. There is a force by which this could lower the cost of capital in the economy for green projects, and that could bring this in. But we want to highlight this force here, that there is this fundamental tension between competition between investors for association with social value creation and the ability to efficiently kind of utilize a concessionary capital force. So you don't want your concession to be going to something other than impact creation. What you'd rather do is use your concession to subsidize a firm that wouldn't have been able to get financing in your absence. And the idea of how you can make more money and have more impact is relative to this other equilibrium with these values-aligned investors, where you're kind of making an inefficient concession. You can make a slightly smaller concession, redeploying that productively to fund a marginal, non-commercially viable opportunity. And interestingly, that opportunity might not be the most socially valuable one in society. You want to, it's just going to be something that's currently not financed but has positive social value. Okay, so I just want to show you graphically how I think the equilibrium in this model works. And in the baseline model in the paper, projects are binary. They either happen or they don't, and if they happen, they generate pi profits and W social value. And every point in this space is a potential project, and there's some distribution of projects in this space. And what this graph is showing is, in equilibrium, which of these projects are financed. And so if it's shaded, they're financed. In this unshaded region, these projects go unfinanced. So what you can see here, RC is the commercial cost of capital that's provided elastically. So anything above that is going to be financed. If you have values-aligned investors, they're actually going to displace commercial investors and finance things that could have been financed by commercial investors. They're also willing to make some concession by financing things that are not commercially viable, as long as they have some social value. And this slope here is the extent to which these investors trade off social value and profits. So again, what's interesting is that in this region, kind of cost of capital is decreasing for these companies, but that's all going into the pocket of the owner of the company, the previous owner. Say, as we start to care more about this, there's going to be rents to the people who currently own the security or to the entrepreneur who starts it. And you can see, now let's compare it to the impact-aligned equilibrium. Okay. So in the impact-aligned equilibrium, and you have to trust me that like the mass of this is the same as the mass of the other region. Right? None of these impact-aligned investors want to displace commercial investors. They don't want to compete with commercial investors to invest in things that could have been commercially financed. So if you compare these regions, if you think about the average W in the funded region, it's going to be higher if everyone is impact aligned. And that's like a kind of a trivial result of the paper. But the idea is that these investors are not displacing commercial investors, leaving them to finance more and more social value positive projects. And this is just what the equilibrium looks like if there's both types of social investors. So the impact-aligned social investors think about value-aligned social investors just the same as commercial investors, as somebody who cares less about impact creation that they don't want to displace. The impact-aligned investors are very happy that someone else is financing a highly profitable, highly socially valuable company. We don't want to compete with them. We don't want to raise the price. We don't want to displace them. Okay, now I'm going to talk about two kind of implications or extensions of this framework. So one is thinking about how do green bonds fit into this? Are green bonds something that can generate impact, or do they fall into the same category? So to do that in the paper, we extend the model to think about their firms having an intensive margin of scale. So instead of just a fixed supply of unit of capital the firm needs, there's a variable scale this firm could be at. And the idea is I want to think about is there could be some commercially optimal level, K star, for a firm size, but it could be that there are marginal returns to social value that people want to create, even if the commercial capital market sees that the marginal returns to investment in terms of profit are below the commercial cost of capital. So the idea is to use green bonds, right? You say, okay, well, we have this green project we want to do. Let's issue a green bond to finance that project, and maybe we'll get a lower cost of capital because people are willing to fund this green thing when the commercial investors weren't. And there's two things that are interesting here. And depending on how much you think about this, it could seem trivial. But one is that having a separate security and having two different costs of capital, it creates an efficiency where you can have commercial investors invest in the commercially viable part of the business, and social investors at a lower cost of capital invest in the concessionary part of the business. And that's better than if you had one security, because if you had one security, you'd have to kind of use all your limited social capital, your scarce social capital, to fund the commercially viable part of the company. And there's an opportunity cost of that capital, which is to deploy it to other socially valuable opportunities. Okay, the second thing, though, is this only generates impact if we know that this kind of marginal project that's being financed is not commercially viable. But green bond rating agencies don't look at that. All they do is they certify, is a green bond investing in a green project? They don't look and say, could this firm have financed it with their normal capital, at their normal corporate cost of capital, or something that's commercially viable? So I would say if green bond rating agencies wanted to get better and help investors feel they were generating impact, in addition to certifying the greenness, they should also certify the unprofitableness of the project. And that would make people feel comfortable that their investment is pivotal in generating impact. Okay, now I want to talk about the enterprise perspective. So instead of thinking about how investors can make impact, think about how firms can make impact. And this idea of an opportunity cost of social capital becomes important here. So think about, I want to define the enterprise impact of a firm as the direct social value the firm creates, less the social opportunity cost of the capital that was used to finance that firm. And the idea there is, if I'm using concessionary capital as a firm, right, that capital is scarce, right, and it could go to help fund some other marginal, unprofitable opportunity. And so that means if you think about impact in this way, there's two dimensions I can increase social value of the firm. One is by direct impact creation, and one is by reducing my reliance on social capital, because that will free up that capital to go to its next best use. And so one way to reduce your reliance on socially aware capital is to become more profitable so that commercial capital is interested in you. So therefore, I think the lesson is firms that are kind of on this boundary of accepting social capital have to think carefully about when they want to become more socially responsible, which dimension do they do it in? Do they do it in the direct way, or do they do it in the indirect way? And it depends on what the firm's investment opportunities are. Right? If the firm has a high cost of doing something that's green, it should do the thing that's profitable instead to reduce its dependence on social capital and let the efficient kind of social capital market deploy that capital to its next best use. Okay, so now, how much time do I have? 10? Oh, wow, I've gone pretty fast. Okay, so we'll get to skiing a little early today. I want to think about, I want to just show you briefly some of the a little bit of empirical work we did here to think about, does this model kind of hold up? And I'm only going to show you one thing, but I think that a couple things we need to think about to see, is this theory relevant? is one, are there kind of projects in this region up here? Are there projects that are socially good and highly profitable? And I'm not going to show you any evidence on that today, but it's something I'm thinking about trying to quantify. Because to the extent there's not a mass in this region, this theory is not relevant. If there's no companies that people might be naively displacing commercial investors from, this is not really an important theory. But I'm not going to have anything to say today. The second thing we want to know is, what are the actual preferences of investors in the economy with respect to social value creation, right? And I've been pushing this narrative that people actually want to make the world better, but it's not clear that that's what people want. People could have like warm glow preferences. They just want to be associated with things. They might not care about actually making the world better. And that's in the literature and in kind of public discourse, that's a hotly debated issue. And I don't have slides for this now because I thought I was going to go longer, but what I would have shown you is kind of narrative evidence from the advertising of mutual funds, that they're trying to use language suggestive of the idea that if you invest with us, you're part of the solution of making the world a better place. These investment managers in the US at least have to be very careful about fiduciary duty. They can't say things like, we're going to make an explicit concession to make the world better, but they do try to get people on board with the idea that this is the right way to help make the world better, to invest in like an ESG tilt or a low carbon fund. Okay, the last thing we need to know is, looking at the investment landscape out there, do investors look like they're doing one or the other of these things? So what I want to show you is I collected data on all the ESG and social mutual funds, and I looked at the companies they invest in, and I tried to find crude measures of their social value. So that's another hotly contested area of the literature, but I used an ESG score, right? And that has all sorts of problems I don't want to get into, but just bear with me and assume it is a good measure of social value creation. So what I'm doing here is I'm looking at the relative portfolio weight of social funds versus non-social funds at the stock level. Okay? And I'm seeing, can I predict, based on stock characteristics, if an ESG fund is going to be relatively overweight that stock relative to a conventional fund? And it should be no surprise that ESG funds are overweight high ESG score stocks. What I'm looking for, though, to see if anyone actually explicitly is internalizing this issue of displacing a commercial investor, is I'm looking at measures of profitability. So if you're an impact-aligned investor, you kind of want to stay out of this region. So I'd expect you would go for higher social value stocks, but you might go for maybe a slightly less profitable or less lower future growth expectation stocks. And I see no evidence of that in the data. And I don't want to claim this is an amazing discovery. I think it's totally obvious that if you read about what these mutual funds are doing, they're not doing this. They're not saying, oh, I'm going to pass on Tesla because I know lots of commercial investors think this is a great thing. I'm just kind of documenting that it doesn't seem to be that way. It's not a surprise. And then the question is, what investors am I missing here? This market is very big relative to the explicit concessionary capital market. There is an explicit concessionary capital market that makes investments in social housing or solar panels. They explicitly take concessions on their investment. It's very small relative to this ESG industry. So the extent people who are putting their money into ESG or social mutual funds do care about this, I think there's a big opportunity here to change the way these funds are helped to help more efficiently kind of shift resources into the higher social value aspects. Okay, so just to conclude, there has been this enormous shift to social investing, but I think there hasn't been enough rigor in thinking about, well, what are the preferences behind this? What do people actually care about? And if they do care about making the world better, what's the right way to use your wallet to do it? And we've highlighted this idea of displacement, right? That these kind of a choice to fund a green profitable company could displace a commercial investor. And in my model, I have this exogenous external capital market. So this example doesn't quite fit. But we did do a version of the model that was general equilibrium, where there was a fixed size of the kind of commercial capital sector. And in that model, you get more results, but you also get this idea that you can literally have this displacement, right? Where you displace someone who was funding something green to go fund something brown because you kick them out of the green thing and they don't care about green versus brown. I think our main result here is not this idea of additionality, but the idea that once you think about the competition between socially minded investors, it does create a problem in the sense that there's a limited scope for impact, and the competition is an inefficient way to deploy your concession. And so you can actually do better both on impact and financial returns by deviating from these kind of ESG or social value tilt strategies. We talked about this alignment between social value and profits. For some firms, it might make sense to focus more on profitability to reduce your reliance on social capital, and free up commercial capital. And then I talked about how green bonds can be used too. All right, thank you guys very much. Look forward to the discussion.